Hello, my dear students. I have a very interesting information for you today. As the business goes on, the most common thing that happens in the business is earning a revenue, selling the goods. Every day there are sales. Whenever a sale takes place, we have an entry made, and the entry is made in the journal, and we write it cash account debit to Ramesh, to sales first. And this is a cash sale. Whenever goods are sold for cash, this entry is made and we receive the cash. That means if anybody comes to you and says that I don't have cash, but I want to buy the goods, you can say, all right, we can sell the goods on credit, but that is a very risky affair. Selling goods on credit means you are not getting cash. And the person to whom you are selling the goods may make the payment to you soon, may make the payment a little later, may also turn out to be a bad person, and he doesn't make the payment to you. Therefore, whenever you sell goods on credit, you have to be very careful. There are two types of persons. One, whom you know very well, and you have been having dealings with them for quite some time, and they have proved their worth. They are reliable people. They are credible people. So whenever such people come to you and they ask you, please, I want to buy goods, but I don't have money, you say, okay, doesn't matter. Money will come later. Okay then, here is a deal. And you sell goods for 40,000 rupees to a person who doesn't have money. So you have that. Here is a person who came to you to buy goods, and you now pass an entry, Ramesh debit to sales. Now this is for goods sold on credit. Goods sold on credit. Ramesh becomes your debtor. He has promised to pay later. Later on he comes and makes the payment. You said, fine Ramesh, thank you very much. Here is cash coming in, and Ramesh is paying this cash. It will be cash debit to Ramesh. Ramesh has paid the cash. We will say received cash from Ramesh. You sold goods for 4,000 or 40,000, whatever the case may be, and here is Ramesh coming to you, making the whole payment, or he may make a part payment. He may make payment of only 30,000 rupees, no problem. As he likes, he can make the payments. So this thing continues. This is cash sale, this is a credit sale, and this is cash flow. This continues when people are very well known to you. Now there comes a person. He requests you that I want to buy goods on credit, and here is the card. Here is my card. And he gives you a reference also of a person who is known to you, that I have been sent to you by this person. So you just give a call to that person. Well, this person say, Amit has come to me Do you know Amit? The person whose reference he is giving, he tells you, yes, I know him, but look here, take your precautions. I don't guarantee the payment. You take your own precautions. If you are satisfied, fine. Give a call to his banker, ask the banker, what sort of person is Amit? The banker says, well, he's fine, he's having a lot of money in his account. So, we have to take precautions that such a person is credible. Still, if there is any doubt, there is a way out. There is a way out. What is the way out? We tell Mr. Amit, I want to sell goods, you want to buy. But because it is our first interaction, you have come for the first time, you have to give me in writing that you will make the payment and sign this paper and give it to me. Now, this piece of paper is very important, people. It contains an undertaking from him, a promise from him that he will make the payment after 3 weeks, 4 weeks, 5 weeks, whatever the time. Now, this piece of paper, in short, I can say this is a bill of exchange. This piece of paper is a bill of exchange. I will sell the goods to him. I will sell the goods to him and will get in writing from him that he will make the payment after 3 months. Now, what entries will then be passed? Here is the credit sale to Amit. Amit debit to sales. Goods have been sold on credit to him for 10,000 rupees. Now, Amit is the person whom I am telling, Mr. Amit, give me in writing. He says, okay, I do it, give it in writing. Tell me what I have to write. Okay, he gives in writing that he will make the payment. Now, in this case, Ramesh, goods were sold on credit, but Ramesh paid cash later on. In this case, Amit gives you immediately something in writing. That piece of paper, we call it bills of exchange. And this piece of paper, I will keep carefully under lock and key for 3 months. I will get this bill from him, debit to Amit. Amit is giving this. So this entry will be passed for 10,000 rupees. Now, once I have written this piece of paper is an important piece of paper. I will preserve it for 3 months. After 3 months, Amit comes. Sir, here is your money. I say, okay, give us your money. He said, wait, you give me my piece of paper back and get money from me. I said, okay, you give me cash. He gives you cash. And then cash is then I give back this bill to him. Now look, this bill he gave, piece of paper he gave, and I credited Amit. Amit was debit here, Amit is credit here. Now I have to receive money for this piece of paper. He comes, pays cash, takes away the bill. Thank you, Amit. You paid the money in time you promised. So when again and again Amit comes, he will be a trusted person, well-known person for us. We may do away with this. No bill of exchange now. Then it will be simply like Ramesh to sales, Amit to sales, so credit silver. Another point here I want to tell you that this is a piece of paper for which I have to receive money. I will preserve it because I have to receive money. So this bill of exchange is technically called bill receivable. Bills receivable. And instead of writing bill of exchange, when we make entries in the journal, we don't write bill of exchange, we write bills receivables. Bills receivables, this is a very common bills receivables account debit to Amit. And when Amit comes to make the payment, we will here then write bills receivables. This has been given. So this is a bill which is bill receivable. Now the point is what he writes in this piece of paper. That is important, because supposing Amit doesn't make the payment, he doesn't come after 2 weeks, he doesn't come after 3 weeks, and his intentions are bad. He doesn't want to make the payment. Then I can go to the court with this piece of paper. But this piece of paper then must be according to the language given in law, language given in an act, and that act is called Negotiable Instruments Act. This is the act. In this act, there is a definition given to the bill of exchange, and this must be in that very format which is given in the act. And what does that include? It includes, and it is something like this. In this section 5 of this act says that a bill receivable or a bill of exchange should be in writing, not oral. It must contain a specific order. Number 2, it must contain a specific amount. It must contain a specific period. It must also contain where it will be paid, place, right? And last of all, it will be written that this money is not a grant, it's not a loan, it is money is paid because the goods have been purchased. The fellow has purchased goods, now he is writing this. So it will be in an order. Now, who will write this? Who will write this? There are two parties. One is seller, the other is buyer. Amit is our buyer, and we are selling goods. The seller will write this. The seller will write. The act says the seller will write it. And what will he write? Pay to me or my order. Now, pay to me. Pay to me. It is not please pay to me. If you say please pay to me, it is a request. No, it is pay to me. It is an order. Pay to me, or if you don't want to pay, then pay to my order. Pay to me or my order. To whom I tell you to pay. It cannot be that please pay to me. It is an order. Pay to me or my order the sum of rupees 5,000. Exact amount. It cannot be pay to me the sum of about rupees 5,000. Or it will also be after 3 months. फ्रॉम द डेट, आज की डेट के बाद 3 महीने, अमाउंट विल बी पेड एट दिल्ली। स्टिल किसी बैंक का नाम भी हो सकता है, बैंक का नाम भी हो सकता है। सी, पे टू बी, इट इज एन ऑर्डर, and order is unconditional. It is written in the act, no condition. It is pure unconditional order. Pay to me or my order the sum of rupees 5,000 within words, and within words में भी होगी ये figure, after 3 months from date at Delhi, and last words will be for value received. This is the language, and see what is important. It is an order, unconditional order. These are the elements. It is unconditional order, कोई condition नहीं, unconditional order. Certain sum after a certain period at a certain place for value received. For value received. Unconditional order, certain sum payable after a certain period at a certain place for the value received. That means the buyer has received the value. He has received the goods and he has agreed to pay the price of the goods through this. Now, who is writing? Seller is writing. So seller will put his signatures here. Signature of the maker. Who is the maker? The seller. Remember this. Seller is the maker, and this is an order. And remember one thing. Order has got no value if the order is not accepted. If you order somebody, bring a cup of tea for me, it is an order. But the person to whom you have given the order, he doesn't care, he doesn't listen to you. So what is the value of the order? You can write an order on a piece of paper and put that piece of paper in your pocket. It is worthless order. So what I mean to say is, once it is written, it will be presented to the buyer. Mr. Buyer, please read it. जरा पढ़ लो इसमें क्या लिखा है. And if the buyer says, no, I don't know English, तो उसे समझा दो that it is written in here that you will make the payment either to me or to my order after 3 months, the sum of rupees 5,000, both within brackets in words and figures, for the value received. And then the seller will request the buyer, इस पर अपने sign कर दो, accepted लिखकर. The bill of exchange must be accepted. And once the buyer accepts it and puts his signatures there, he will return it back to the seller. वो अपने पास नहीं रखेगा. He will return it back to the seller. Seller will keep it in his file. Now this is a legal document. If the buyer refuses to make the payment, then the seller can take him to the court and recover the amount by filing a case against him. He can sue him and recover the amount from him. This is how the bills of exchange happen. And this act also provides one more document, which also is a bill receivable. And that is, this is written by the seller. When the seller starts writing, the buyer tells, look here, Mr. Seller, you don't write. I will write it. And the seller said, okay, Mr. Buyer, you write it. Now, what the buyer will write, that is also given in this act under section 4. That is known as a promissory note. The buyer promises to pay. This is an order to pay from the seller. When the buyer writes it, the buyer will write as if he is telling the seller, Mr. Seller, I promise to pay to you or your order the sum of rupees 5,000 after 3 months at Delhi for the value received. And he signs it. Who is signing? The buyer. The buyer is signing. So this does not need any acceptance. This does not need any acceptance. I repeat, this is an order to pay when the seller writes it. Now, if the buyer writes it, he will write, I promise to pay. I promise to pay to you or your order. I promise to pay to you or your order. बाकी सब कुछ सेम है. The sum of rupees 5,000 after 3 months from the date at Delhi for value received. Now, this will be signed by the maker. Who is the maker now? Now the maker is buyer. This is called process. Legal worth, both are the same. Both are bills receivable. He writes it. After writing it and signing it, he will give it to the seller. Promissory note. This is promissory note. He writes it, signs it, gives it to seller. What about bill of exchange? A bill of exchange is written by the seller. After it is written by the seller, it is given to the buyer. The buyer reads it and writes accepted, your order accepted, and signs it. Then gives it back. This is the movement of the bill. Promissory note written by the buyer goes to the seller. Bill of exchange written by the seller goes to the buyer. Buyer signs it, accepts it, and then it comes back to the seller. This route must be remembered. It will help you in making the record. Promissory note, it is written by the buyer and it is given to the seller. It is written by the buyer and given to seller. This one is written by the seller, given to the buyer for acceptance. After accepting, he returns it. Now, once a bill of exchange is accepted and given to the seller, once the promissory note is written and signed and given to the seller, for the seller, this written piece of paper is a bill receivable. And for the buyer, the same piece of paper is a bill payable. The buyer has to make the payment for this, it is a bill payable, and the seller has to receive payment for this, it is a bill receivable. So this was what I wanted to tell. What is a bill receivable and what is a bill payable? Why do they come into picture? They come into the picture for the sake of selling and buying goods on credit. In case the person or the buyer and seller meet each other for the first time, in order to test the credibility of the person, bills of exchange and promissory notes come into the picture, and they are very common these days in the business. People use these documents very much. I'm sure you have followed the meaning of these two terms. Thank you very much.